Some advisors say munis still make sense for your portfolio, despite the risks. Plus, the Fed's backed into a corner, says Dow Jones' Paul Vigna. He'll tell us what's next. Plus, 2009 was a very good year for some wine investors. We'll tell you how you can invest in this bull market. I'm Veronica Dagger, and welcome to Wealth Advisor. Despite some states' funding crisis, muni bonds are still a good pick for some high net worth investors' portfolios, says financial advisor Jim Pratt-Heaney. But not every muni bond is created equally. He tells us why he likes munis and what to look for before you invest.
The old strategy of buying a couple of bonds and clipping the coupons has gone forever because the rating systems are different. We saw in 2008 AAA bonds that were actually worthless. So a person has to get professional help, I think, at this point for all their bond portfolios.
So where do you see opportunities within the muni bond market?
Well, wherever there's bad headlines, there's opportunities, right? Okay. So right now everyone thinks every state is going bankrupt, municipalities are falling apart, when in fact, many municipalities are in better shape than most countries, including in our own. So there are opportunities, say, in a bond from California. People may be nervous, but it might be a really good municipality or a strong college or some type of revenue. So the price might actually be cheaper now. So we think it's a great opportunity.
The Fed is being backed into a corner as the economy teeters between recovery and a tumble back into the muck, says Dow Jones' Paul Vigna. What's the Fed chairman's next move? We asked Paul to weigh in.
They have to do something, but they've already done so much. Interest rates are so low. They're obviously going to keep the overnight rates at zero for the foreseeable future. Their usual policy levers are long gone. Now they have to start going into gray areas they've never gone into before. And what they've been thinking about, what they've been talking about, everyone's talking about, is this QE2, quantitative easing, a big treasury buying program. No one knows the size of it. It could be $100 billion a month for however long it takes. I don't think that they should embark on this program. I don't think they should do QE2. I don't think they should commit themselves to spending another $100 billion or $1 trillion or $2 trillion or whatever the number ends up being. I don't think they should do it. I think the risks outweigh the benefits. I think the Fed should say now is the time that the economy is just going to have to recover on its own, and as long as this takes, this is what it's going to take. I mean, this is what people talk about. They talk about central bankers being responsible. You talk about fiscal austerity. You talk about all these things. You talk about saving the dollar. I mean, that's another thing. What'll this do to the dollar? You've seen what has happened to the dollar in the last month. When people are just talking about this program, the dollar has gotten shellacked. So, do you want to save the dollar? Do you want the dollar to be a legitimate, strong currency? Don't do this. Do you want the Fed to be seen as a responsible, sober central banker? Don't do this.
The uber wealthy in Asia are helping fuel demand for wine investments. But you don't need to be a billionaire to get involved in this market. Sure, you can buy a 2009 Bordeaux, but there's also wine investment funds to consider. We've asked the Wall Street Journal William Lyons to tell us more.
Since the sort of professionalization of wine investment, we've seen the emergence of trackers. I suppose the most famous one would be LiveX, which is based over here in the UK, and that tracks the top 100 fine wines. The other one you can look out for is winesearcher.com, which tracks the price of every single wine there is in the market. The small number of Chateau in Bordeaux that everyone is sort of piling the cash into at the moment, things like Chateau Lafite and Chateau Latour, have become brands in their own right. So their wine is of such a quality that they're not seeing a downside every vintage. All they're seeing is an upside. So the 07s are not as good as the 09s, but the 07s are still very good. The key thing is every April the Chateau in Bordeaux get together and they release their wines through a process called en primeur, which is a year ahead of them being bottled and shipped. They all get together and form the first opening prices. Then a sort of wave of critics will go down, try the wines and put their views into the marketplace. The key driver of this is an American critic called Robert Parker, who in the late 70s devised a way of rating a bottle of wine out of 100 points. Now, if he gives a wine 100 points, the investment potential is enormous. So he is the driver. Quite sadly, it's down to one critic, but he determines the price of the wine.
That's it for this week. Wishing you prosperity. I'm Veronica Dagger for Wealth Advisor.